Shares for Beginners.
Learning how to generate incredible fitness, wealth, takes time, it takes education, and it just takes doing the fundamentals right over and over again. And then keeping that fitness and wealth for a long period of time also requires you to do more of the basics the same over and over and over again. And you don't have to worry about all the noise telling you to do anything risky or out there, or if it sounds too good to be true, it probably is. So just avoid that. But that's the hardest thing. Like, delayed gratification is not something that everyone can harness. It's really challenging.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. Investing is full of sporting analogies. Markets can be on a sticky wicket. We're in the fourth quarter of a bear market. It's a marathon, not a sprint. Joining me today is the Investor Education and Events Manager from the Australian Shareholders Association, Leigh Gant, who has a distinguished career in investing and sports coaching. Hello, Leigh.
G'day, Phil.
Thanks for coming on and thanks for joining me today. Fully hydrated, I believe.
That's right.
Carved up and fully hydrated.
Yes, I've been rushing to get enough fuel in to hopefully provide a great podcast for you.
Okay, and just before we get started, I just wanted to do a quick shout out to a listener, and I got some feedback which I'm just still blown away by. It was so nice. Unfortunately, it was anonymous, so I can't tell you your name, but you're Mr. 35 to 44 in WA, and it was about the 4th of August that you left the feedback. So I'm very moved and touched, and thank you very much. So, Leigh, you've recently joined, well, it's not so recent now, you've joined the association, what, about a year ago now? Is that the case?
A bit less than that, but yes, I've been here all of 2022.
Yeah, and long-term listeners to the podcast will know that I do go on about the association quite a bit and what a great place it is, especially for education, of which you're in charge of now.
Yeah, that's right. We're steadily making way in trying to improve actually what we do for education. I think, you know, the ASA is a fantastic resource, but at the same time could be a whole lot better. And that's why I'm here, really, to find out how and what we can do to improve investor education for retail shareholders in Australia.
And we'll mention at the end of the podcast, we've got a freemium deal going on at the moment for listeners of this podcast. The promo code is Shares22, but we'll repeat that again and it'll be in the episode notes. So tell us about your previous career in sports coaching.
Well, I've got a long career, I guess, in entrepreneurial pursuits, and it could definitely be considered sport coaching. That was part of it. But I like to think of myself perhaps a little bit more as a small business owner. And at one point, it was expressed as sport coaching. So
sorry. I got the bio information all wrong.
No, maybe I'm just trying to be a little bit more humble in my approach. But yes, I'm fortunate to have worked with quite a number of professional and semi-professional athletes. My journey is owning a couple of gyms, an online coaching business, before transitioning into finance. So I've had the great pleasure of being around some professional sporting teams, Olympians, and more recently, and probably what I was better known for, was in the CrossFit space, where I've worked with CrossFit Games athletes.
What was it like working with athletes? And were you working with them in terms of coaching and money coaching as well? Was there a bit of a crossover there? Working
with athletes is an incredible experience. It's not for everybody. As hard as it is to be an athlete, it's equally challenging to be a coach. My organisation and the way we coached, particularly me, was always to try and make someone, fantastic on the field, whatever sporting field they're on, but more importantly, help them become better humans. And more often than not, that turned into them being able to perform better. When someone is able to take care of their inner self, their physical expression becomes unshackled. So a lot of my work had to do with mindset, habits and behaviours right at the sort of base level of their lifestyle. And then physical expression and training was sort of the icing on the cake.
You mentioned about the focus and the discipline of these athletes and also trying to help them to become better human beings as well. I guess that part of it is that a lot of these athletes have trained and done nothing but training and have very little social life for the bulk of their life from childhood onwards and into adulthood. Is that the case?
It's not always the case. There are rare exceptions for people who are just so gifted that they can do exceedingly well even when they are very social. However, the most common case is that athletes, particularly at the semi-professional level, where they're not earning a lot of money, if any money at all, to follow their passion, they're so heavily spirited and passionate about what they want to do and what they want to achieve. They're so goal-driven that it's not a sacrifice to not have a social life. It's really aligned with who they are as a person to put that time and energy into achieving sporting success. Not everyone makes it. In fact, very few really achieve their highest or biggest, most audacious goals that I worked with. And that doesn't mean the others weren't happy with the outcome either. Everyone wants to be a winner, but at the end of the day, there's only one winner. So that means
there wasn't any bronze medal syndrome.
Sure, there's disappointment when you don't achieve your big goal.
Yeah.
But big picture, I think, and long term, I hope that most of them will reflect, 10, 15 years down the track and know that the processes that they put in to get to where they got to transcended into the rest of their lives and has allowed them to achieve success in other areas.
I remember speaking to Ted Richards, who was a footy player with the Sydney Swans and who works in the finance space now. And he was talking about some of his co-players who were very young and got suddenly very wealthy very quickly and ended up blowing the money. Have you seen any of that kind of syndrome with athletes and people who've made a bit of money?
Yeah, absolutely. Yeah. You see or hear stories about particularly young professional athletes who get paid well and truly more than your average wage to play a game, to pursue something that's at the end of the day really, really fun. And they can fall into any types of traps, bad business deals, pursuing like really speculative assets to try and make a few extra dollars and it blows up on them. And everyone knows that athletic careers don't last forever, and the very few that do have long careers, still at risk of losing what their job is every day they go out on the field.
You mentioned that you were very green previously when you first started your first business. What was it like being thrown in the deep end? Really
scary. I was very confident. Externally, I present a picture of a lot of confidence, and that hides all my insecurities,
as we all do.
I have a deep faith in my ability to learn, so I don't mind being thrown in the deep end and perhaps putting out the perception that I know a bit more than I actually do, because I'm very keen on learning. I love learning. I'll dive into any area that speaks to me and go very deep very quickly. Yes, it was extremely scary because the business that we started big. I had a great business partner that played to his strengths and I played to mine. And we started very big. Most people start, particularly a brick and mortar business, they don't start as big as we did. We went all in. And the first 6 months of actually being open was extremely challenging because we needed to find our feet, not only as a business, but really as who we were as operators. And the business took on many subtle changes that perhaps the clients didn't realize all of them as we found who we were as operators and where we fit in the market. And once we did, and once I figured out how to be a better leader as well, our business, accelerated very, very quickly. So we learnt to swim out of that deep end as fast as we could so that we didn't drown.
Having experience as a business owner, do you find that helps in terms of being able to assess other businesses for investment purposes?
Absolutely. My background at university was psychology. Throughout high school, I was not a fan of mathematics at all. I much prefer artistic and creativity things. However, when you own a business, you need to learn accounting very quickly and you get severely punished if you don't. So that learning curve was steep, but I needed to go on it very quickly and get ahead so that we can operate a business. And everyone wants to be profitable, and it's crucial that you understand how and where profits are derived from. So once learning to read financial statements and do very basic accounting became more important to me, I was able to learn it. And now you can look at any size business as a shareholder with that fundamental understanding and get a clear concept of where the business is at, where it's going, and where it's been. I like to find businesses that are owner-operated companies. There's a bit of synergy there between, having been an owner-operator and then I want to invest in other great owner-operators. And part of that is just having faith that they truly understand what's going on with the business.
Yeah, although I'm going to push back on that owner-operator thing as well, because I just had this experience this week. Fortunately, I wasn't invested in them, but I won't mention the company ticker, but they delisted and went bankrupt, I think, this week. But and it was an owner-operated business, and they had fantastic contracts with large software providers, large tech firms from around the world. But it turned out that the co-founders were paying themselves huge amounts of money, and their self-interest was basically self-directed. So it can go both ways, I believe. Absolutely.
I think, going back to asking why is it so important for me to have or learned as a business owner, I had dreams of paying myself quite handsomely as a business owner when I first opened the business. We all did, and we quickly realised that that's not the right way. So I think, Warren Buffett and Charlie Munger talk about one of their investing tenets needs to be that it has excellent management with integrity. Munger puts it more crassly that, a business needs to be able to be so good that it could be run by a monkey, because one day it will be. So as a previous business owner, I know what I'm looking for in my due diligence. Not, no offense, Phil, if you miss this point, but I'm looking for, businesses that they have owner operators like myself. They don't overpay themselves. They're looking to, create a wonderful company for the long run. And those that overpay themselves are shooting themselves in the foot.
So do you feel like you've got that ability now as a business owner to do that, you've self-assessed yourself and to see that other business owners are possibly going through that similar kind of self-assessment in how they're running the business?
As an investor, it's difficult because if you're listening to earnings calls or reading reports, management are going to try and always put their advertising hats on. They need to go out into the world and tell everybody how great the company is. The best managers are often very frank and will be honest about a quarter or an annual performance. You have to take what they say with a grain of salt. However, managers I truly think are fantastic, or owners or CEOs are truly fantastic. Some that come to mind, like Tom Gaynor, CEO of Markel in the US, they're very frank and honest, and they'll tell you exactly what's going on with the company, and that comes through, and I recognise that.
Yeah, I'd recommend listeners study up a bit more about Markel, because they're kind of a mini Berkshire, aren't they?
Yes, indeed.
That's how I've heard them described, yeah.
Yeah, absolutely. And in fact, Berkshire Hathaway did purchase a small amount of, relatively small when we're talking Berkshire, a small amount of Markel last quarter. So there's definitely aligned interests there.
Yeah, because they focus on management, good business, good accounting practices. And I think they've got an accounting background, and that's really what they're looking at as the company really truly based on the figures themselves.
Yes. And the CEO, Tom Gaynor, he's been there for a very long time. Its main business is insurance, just like Berkshire, and they take their pool of funds from the insurance business to invest in private and listed companies. And Mr. Gaynor has a great track record of doing so.
And some great reading there as well, just if you want to get off the Munger Buffett route.
For sure.
Then I'm sure it wasn't as simple as that you went into the Motley Fool, but at one stage in your career, you went to the Motley Fool. Tell us about that.
After selling my last business and closing down my online coaching business, I needed to take some time off and recover. Owning small businesses and trying to push for growth for many years, left me extremely fatigued, and I had actually achieved everything I wanted to as a sport coach. And so I was left a little bit goal hungry. Throughout 2019, 2020, plenty of self-assessment and figuring out what I really wanted to do next. Investing had been something that had floated in and out of my life since I was a teenager. Very fortunate to have invested throughout that time, but very passively. And I thought it was something you just did a little bit on the side for the future. Again, it's really lucky that I had my father kind of school me in long-term investing approaches, but I didn't know that trading or anything else was something that people did. Really, I just thought you bought shares and left them alone for a long time, and then when you retire, that's what you lived off. So very, very fortunate there. However, once I had the free time away from small business, I found myself getting more and more interested in reading about great investors and learning more about investing as a career. And suddenly I found myself with a goal of making it a full-time job. And the opportunity came along at the Motley Fool, and I swung the bat and went all in, and was fortunate to get a role there as an analyst and writer, which was a great place to start a career in investing.
So I'm assuming that your dad was from that generation pre-ETF, where there wasn't immediate diversification available from an ETF, although maybe there would have been LICs. Was he the kind of person that would get the old stock certificate and put it away in the drawer?
Yes, he was, yes. And it's all been, I think, a master plan of his to just perform this inception on me to become an investor. One of my fondest memories is sitting with the AFR and when all the stock prices were printed in the paper, and getting out a ruler and finding companies that I understood or knew about, Telstra, Commonwealth Bank, and chatting about the share price changes over time. And, I was a teenager, so now I look back, closing in on 40 and thinking, wow, that's lucky. Not many people get to do that. So yes, he had a pretty concentrated portfolio of individual businesses that he just held for a really long time, and it's worked magic. So
your education and learning at Motley Fool, I'm assuming, accelerated as well. Were there any key things that you learnt there?
Oh, I learnt a lot. It's really hard to distill it down into a short conversation.
Of course, just give us one or two.
Yeah, sure. I think the first skill I learnt was actually to assess businesses faster. It was like drinking through a fire hose. When I started there, being across many services at the Motley Fool, my stock universe was greatly expanded, not just locally, but internationally, and working with quite different analysts, from Kevin Gandia to Drew Flowers to Chris Copley. They all have different styles, different strengths, and could teach me different things. I learnt more about different ways to value different companies, different characteristics to look in, smaller companies versus maybe larger blue chips, being able to condense that down and communicate it in a simple way to perhaps someone that isn't an analyst, anyone to become a better investor, for sure. It's just simplifying complex ideas is a wonderful skill to have.
Let's get back to talking about the sporting analogies. And of course, the master, Warren Buffett, says that the best investment you can make is an investment in yourself, or something to that effect. I'm paraphrasing here. Because, a lot of investors, they come into the market thinking, I'm going to make a ton of money straight away, especially after Robinhood and all the GameStop and crypto that's been going on over the last couple of years. But then it comes down, the people who are going to be serious about it are going to be serious about education. And it's a bit like an athlete as well. It's basically going in, doing the same thing, doing the laps every day, doing the reps every day. What are your thoughts on that?
There's so many analogies that transcend fitness and sport to investing. If someone's looking to change how they are physically, you can see really similar traps that people fall into when they are trying to make money quickly. When we hear about meme stocks, crypto, and any other speculative asset where someone somewhere has made huge returns in a really short period of time, it sounds like a shortcut. Oh, that's easy. I can take that. And it's kind of the same with fitness. So stepping away from athletes, general population people, they have come to me and said, I want to achieve this body shape or this fat loss or this incredible fitness level, and I want to do it really quickly. And the answer is you just can't. I'm sure you can jump into a short-term challenge or try a fad diet and get a little result very quickly, but it's not going to be sustainable. It's the same as winning the lottery. There's plenty of stories where people have won the lottery and then blow it all quickly because they haven't earned it and they don't know how to keep it. Learning how to generate incredible fitness, wealth takes time, it takes education, and it just takes doing the fundamentals right over and over again. And then keeping that fitness and wealth for a long period of time also requires you to do more of the basics the same over and over and over again. And you don't have to worry about all the noise telling you to do anything risky or out there, or if it sounds too good to be true, it probably is. So just avoid that. But that's the hardest thing. Like, delayed gratification is not something that everyone can harness. It's really challenging for most people. And once you can connect it perhaps with something deep inside, your goals or your personality, then it becomes easier to do. But sticking to the basics, like getting 8 hours of sleep, going for a walk every day, eating less than you need if you need to lose body fat, drink water, smile, see the sun. These are the things that build, incredible health, not crazy 6-week challenges, just like dollar cost averaging, spending less than you earn. These are really easy ways that you can build wealth over a long period of time.
Your dad, you mentioned, had a very concentrated portfolio, and your own investment style is like that as well. Tell us about your concentrated portfolio and how you invest personally.
Yes, well, I've gone through quite a few different evolutions of investing. It's an exploration process, and it's still evolving too, because I learn more about who I am and what suits my personality. So what I'm doing now is different to what I was doing 2 years ago. So I don't want it to sound like I'm a guru who only invests in a handful of stocks. I'm far from that. But after being more diversified for quite some time, I'm getting more and more concentrated. So, Joel Greenblatt has explained very well in one of his books about how diversification beyond 20 stocks, the benefits are not that great. Somewhere between 15 and 20 in terms of holdings is ideal for diversification. I just don't have that many good ideas. Like I've got 24 holdings, and probably 15 are really, really good ideas, or I at least think so. And the next 10 need more research. I think they're good ideas, but they're smaller holdings, and I'm not ready to make them bigger yet. And I'm looking for wonderful companies. I have quite an extensive checklist that would tell me if a company in my mind is wonderful or not. And I want to get them at a reasonable price. The market's been offering us, different prices over the last year for the same businesses. And sometimes those prices are great, and sometimes they're exuberant. So I'm just patiently waiting for a good price.
What are a couple of the columns in your checklist?
I'm heavily influenced by people like Warren Buffett, Guy Spear, Charlie Munger, Monish Pabrai. They all come from this same school of thought about what a wonderful business is. First, it needs to be in my circle of competence, so that I don't understand every industry, and I'm not passionate or willing to learn about every industry as well. So things like biomed, like really advanced technology like AI and such, it doesn't really fall into my wheelhouse. So it's not very simple for me to understand. So if it's too complex, that immediately goes in my too hard basket. I like companies like insurance businesses. We've already mentioned Markel. I own another company, WR Berkeley, again, an insurance company that takes its float and premium money and invests it elsewhere. These things I understand. I understand simple consumer-facing businesses as well. If you understand where the revenue comes from, how they make sales, how it will grow, then it's easy to analyze the business. It needs to be in a growing industry, not a dying industry, so that there's a market for these companies to expand in. It needs to have wonderful management. You can understand that from simple metrics like return on invested capital. Perhaps growing equity is something as well that I look for. So you can see how it starts to expand quite quickly. I could keep going.
Well, it's kind of like you're almost trying to make the best decision possible. And the more metrics that you've got, which add up and you get a tick and a tick and a tick and a tick, I guess that's more how it confirms your belief in the particular business.
Indeed. I also like to think of it from the other direction, invert the story. So if I was to buy an ETF for example, something that tracked the ASX 200 or 300. Not every business in the ASX 200 or 300 is a wonderful business. So if we think of it the other way, what are the things I want to avoid? Right? What are the characteristics in a business I don't want to own? I wouldn't want to be a part owner in a business that is highly leveraged, that doesn't have a track record of growing revenue and expanding margins. If the share market didn't exist and I was fortunate to have a pool of money and I needed to buy some individual businesses to grow my capital over time, I'm not going to buy the coffee shop that's losing money and highly leveraged and can't open more coffee shops in the future.
I mean, that's a great thing about it. And I think a lot of investors still forget that we're talking about businesses here, and that you can become a part owner of this business, and the management and the staff of that business are all working on your behalf.
Here's another element that I learnt from the Motley Fool, and something that Scott Phillips is really big on inside the team, is not referring to a business by its ticker code. We're talking about a real business here with real people. We don't want to rent a 3 or 4 letter code. We want to be part owners in a real company.
Yeah, but it just feels good. You just say the code, you just say the ticker code and you feel more professional about it. But I think that's a great, great from Scott saying that you want to say the name of the business, don't you?
Exactly. I'm not a fan of saying the ticker code. I like to be able to walk around, and if people ask me what do, I can say, well, I'm a part owner in Disney, actually. And it sounds a lot better than it really is.
Yeah, especially with fractional shares these days. Okay, well, let's get back to the Shareholders Association. How are you finding working at the association and meeting the members?
It's fantastic. We had our investor conference a couple of months ago where it was just wonderful to get back to face after a couple of years of really being focused online, and to meet hundreds of shareholders and hear their stories and what they want to learn as well. It's just superb.
Okay, so at the Shareholders Association, what changes are being implemented in the education space?
Yeah, it's really interesting time because I think there's a rise in shareholder education broadly in the market, from beginners or people just wanting to get started in investing. There's so many new avenues, from free content in great podcasts like this one, YouTube channels, even free online courses. There's so much out there. And then for other markets, perhaps the wealth builders and the self-funded retirees, which is a lot of the ASA's member base, my goal is really to understand that persona of the ASA member. What do they really want to learn? I think we can work with others that already have fantastic courses available and help guide them, and almost be like a Sherpa on their investing journey and carry some of the weight of, what do I need to know? What do I need to learn? Where do I start? And that's what really I'm looking to do, is just put a map in front of them and say, hey, here's where you are, here's where you want to go, and this is the way forward.
And I'd commend listeners to go to a members meeting as well, which you can just turn up at, even if you are not a member. For me, it's one of the great experiences of going to these member meetings and talking to some of the wiser, more mature investors, and see how they got to their position where they are, because, getting to that age doesn't take as long as you think it will.
It's an incredible resource. There's over 50 local member meetings across Australia from the ASA, and inside of those meetings, there's a minute community that's part of a larger community, and so many stories and so much to learn from others. What a great way to learn about investing. Go hear the war stories. Mm-hmm. It's really important to hear everyone's mistakes. No one's got a perfect track record, so that would be my first recommendation. And then go and listen to the different takes on what's going on out there, and you will come away a better investor for sure.
And they've got such long memories as well. I just always remember, they talk about some sort of manager, and then someone will pipe up and say, yes, but back in the 90s, he managed this particular company, and, back in the 2000s, she made a mess of that company.
And how handy is that? I didn't know about what CEOs were doing when I was in primary school. So as people can tell me what managers were doing in the 90s, that's fantastic.
Okay, so we'd like to share with listeners that we've got a premium offer for listeners. They can join. It's till the end of December. Is that correct? This offer goes for?
That's right.
Okay. And the promo code is Shares22, and you can get a year's free membership and experience the Shareholders Association, as we both have, as being a wonderful institution that we both love and respect.
Absolutely. We hope some more listeners join us.
Okay, Leigh Gant, thank you very much for joining me today.
Thank you, Phil.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.